Okay, so let's begin today's webinar. Thank you to everyone who has joined our live Zoom webinar today on BG16 Bishop Arts, and for all our investors who will be watching the recording of this event at a later date. Joining us today is Eric Barvin, who will share an overview of our investment strategy and update the projected returns on BG16 Bishop Arts. Following Eric, Jarvin Shen will discuss the dynamics of the preferred equity offering that we shared with all our investors on Friday. After Jarvin, Randy L. will share an operational update, including our retail leasing efforts. Concluding today's call will be a live investor Q&A. We will be making forward statements on today's call. Before we begin, I would like to quickly share my screen for everyone to view this disclosure. Forward-looking statements involve assumptions and are subject to known and unknown risks and uncertainties that could cause actual results or performance to differ materially from those expressed or implied by such forward-looking statements. Although we believe that the assumptions reflected in forward-looking statements are reasonable, we can give no assurance that such assumptions will prove to have been correct. Forward-looking statements are no guarantee of future performance and are subject to risks, uncertainties, and assumptions. Should any of these risks or uncertainties materialize, or should any of our assumptions prove incorrect, actual results may differ materially from those included within our forward-looking statements. Thank you for reviewing this disclosure together and for reviewing the quarterly report and preferred equity notice we shared last week. We hope to answer everyone's questions on today's call. And thank you to everyone who submitted the questions in advance of today's call. Please submit your questions in the Q&A tab at the bottom of the screen throughout the call, and we will strive to answer all questions in the hour allotted. Following today's call, we will send a recording with a link to today's event, as well as a transcript for all investors to view at their leisure. Without further ado, our chairman, founder, and CEO, Eric Barvin, will kick off today's event. Eric, thank you for joining us.
Thank you, Kate. I'm just having a little trouble with my headphones, but I think that you can hear me okay? Perfect. So thank you everyone for joining. And I'm sorry we're having this call today, obviously. What I wanted to do was kind of first start off with, an overview of the investment idea as to the investment thesis regarding the location, the asset quality. When we first got into the project, we liked it because we got in below replacement cost, which today is still unchanged. And it's still a great asset. I want to first and foremost say that what we're experiencing today is a balance sheet issue. It's not a property issue. There's no functional obsolescence with the property. It's very much in high demand, which you'll kind of hear about. We purchased the property in July of 2021. The property BG16, which is now called Bishop Union, represented a high quality asset with upside potential because the vacant retail, the location was emerging in the sense of that it was close, but not directly inside Bishop Arts District. And the property itself was built in 2019. It consists of 302 units with about 21,000 feet of retail. So when we purchased the property, I think most of you will remember that it was during COVID and there was vacant retail. We thought that we could really lease up the retail and grow those in-place rents as the area and submarket continued to improve. The area itself was quickly gentrifying, and we believed that the growth of Bishop Arts would move favorably in the direction of our property. Furthermore, we perceive value in the amenities that the retail would eventually bring to the residents and the diversification of our income stream as the investors. At the time, we had a cardiology group positioned to take a portion of that retail post-closing and obviously post-lease signing. They backed out. They paid us a penalty for defaulting on their obligation. But that, as we'll get questions about discrepancies in pro forma to actual, that income represented roughly $178,000 a year that we expected to get because that was already kind of positioned before we purchased the property. The Vance is positioned obviously in Bishop Arts. It's a vibrant, centrally located Dallas neighborhood that's known for its boutique retail. So within walking distance, and there's something in our business called a walk score, which is out of 100. Vance's walk score is 90, which is phenomenal. And there's 60 different boutiques, restaurants, bars, coffee shops, music venues, art galleries within walking distance to the property. It's also located along the light rail system. There's a stop very close to the property. And so this provides easy access to the amenities in Bishop Arts for people living outside of Bishop Arts. And also it allows our residents to get to numerous employment hubs throughout the city very, very efficiently. So the chart that I want to show now is about DFW. It's a big part of why we got into Vance and what drew us to Dallas. That growth continues. The metro area is home to 24 Fortune 500 companies, headquarters. A decade ago, they only had 4 headquartered there. Among the top 20 metros, DFW is the highest rate of net inbound migration in the country, 4th highest in the country. Most recently, some of the large metros actually shrank, but DFW led the nation in terms of overall net population growth in the latest census. And it's expected to continue in the future. There's a consulting firm we use called Site Selection Group, and DFW itself is projected to grow by 8.64% population-wise in the next 5 years. So we really like the market. We really like the asset. The average income of the Vance resident today is $104,000. The most common job title is manager, followed by business owner or registered nurse, physician, teacher, and lawyer. The property itself is very close to Methodist Dallas Medical Center, which encourages lots of medical professionals to rent there. It's also, people who work at AT&T, Lockheed Martin, Dallas ISD, Bank of America. I know in the past we've had a lot of Goldman Sachs employees living there as well. And the typical resident is in their 20s and 30s. So I want to take your responsibility for getting us here. We used a floating rate loan in August of 21 when we purchased the asset with the idea that we would improve the NOI by really leasing the retail and then refinance the property in a fixed rate loan as the NOI improved. At the time and today, floating rate loans are only available when you're getting 75% leverage, which is what this property has. And since the retail was vacant, we believe that by leasing the retail, we would increase the asset's net bottom line profitability by over $700,000, which translates at the time to roughly $14 million when it was based on a 5% cap rate. Hindsight is obviously 2020, and the yield curve didn't have the short-term SOFR rate growing beyond 1% until 2024. At the time, the Fed was still telling the market they were going to continue to push money into the economy. We didn't expect the Fed to increase SOFR by 500 basis points in 12 months. And that wasn't choreographed in their statements, as you guys probably know, or the yield curve, which is what we're showing here, kind of where it was. This is as of November 21, but we purchased the asset in August. And so it was essentially the same thing back then as well, just further to the left. So in addition, we could have purchased a 3-year cap, but we relied on an interest rate consultant who suggested a 24-month cap. The decision was a mistake. We should have aligned the loan maturity with our interest rate cap purchase, and that's a lesson that we've learned from this experience if we decide to ever go back to floating rate debt. Rising rates are indiscriminate on location, but we focus on Dallas due to its projected economic and population growth. And the apartment portion of the property has continued to do really well and grow rents. In our offering memorandum, if you look back, we said that we would expect to receive $700,000 of retail income in 2024. Right now, we're on track to receive roughly $315,000 of income in 24. A portion of this is made up by utility reimbursements, which we actually underestimated. Those are RUBs, those are income we get from the apartment units. And the pro forma that year, it's $140,000 roughly. And in our actual numbers, it's $265,000. And so if you take that difference and you add in the cardiology group, we would be much closer to our pro forma on the retail. I'll also mention that we used in the pro forma gross rents for the retail. So the leases that we're actually signing today are at those same rent levels, but they're triple net rents. So the tenants that are moving in are signing to pay their share of common area cost. So our actual income from the retail will be higher than what we pro forma. Randy is going to discuss the operations for the multifamily portion, as well as kind of the retail lease up in greater detail when he speaks. And then Jarvin will discuss the rationale of a 12-month cap purchase and why we decided not to work with the lender on this particular asset. I know we have lots of investors who own lots of assets, lots of the same properties. And so we did not work with the lender on this. The sudden and dramatic rate increase caused a shock to the financial markets. It made the property very difficult to sell or refinance on a cash neutral basis, which is why we're here. And unlike other floating rate loans, we believe that this property is capable of achieving its loan extension covenants in 24 and 25 without a loan modification. Therefore, we're only asking for funds to purchase a 12-month interest rate cap to allow us to maximize flexibility in negotiating leverage with our lender. In 12 months, we will determine whether or not we sell, refinance, or extend the current loan with the lender. And given the below debt yield covenant relative to what's actively being marketed by lenders today, ours are 6 and I think 6.15. Today in the market is probably closer to 8. So we believe that most likely scenario will be to use those extensions, but we want to see how the retail leases up and what our options are to roll into fixed rate debt. BG16, obviously has not been a great investment to date, but it's a great property. It's a high demand location and it's a property that's going to get better. I think additional time will continue to build on the positive performance trends that we're experiencing on site. So why is this good money and not bad going in? When we spoke with investors a year ago at our investor day, and again in January, we didn't anticipate such a severe economic downturn as we're expecting today. At the time, I had significant liquidity, and we even mentioned that I might cover the cost if that was something I could financially do at the time. I funded AP needs of the properties with no interest in the past and to avoid capital calls, and done it for over $10 million in different increments. But my liquidity situation is not the same, unfortunately. I've used my liquidity to support other assets that need additional capital. So instead of covering the cost of the interest rate cap extension required by the lender, I'm offering to backstop that preferred equity raise by up to $500,000 above my proportionate share of the investment in the property. So our interests are very much aligned in doing this. The idea of investing additional funds today makes sense because we feel confident that NOI will continue to improve and that the property is likely to achieve its debt yield test and make it eligible for its extension. There's also equity at today's current value. So even in these high interest rates, there's a lot of equity still in the project from a value perspective. And so we want to maintain that equity. Continued population growth and retail around this property in this area is going to continue to accelerate the need for housing here. And it's gotten much more expensive to acquire a home. So many are choosing to rent instead of buying at the moment. And I think that as the retail tenants move in, which Randy will talk about, that just creates more incentive to live at this property because of the difference in retail tenants. So now, let's look at this slide, because this is the return slide. This is kind of what everyone wants to hear, I think. So in the capital call letter, we show a projection through July 2025. That's essentially the first loan extension. So that we have until July 2026, but these forecasts actually go through July 2027 and then 28, because we kind of looked at it as a 10-year hold. The 10-year hold would be 2031. So these are obviously pro forma projections. Having invested in apartment communities for almost the past 15 years, I realized that the only fact about a pro forma is that the outcome is going to be different than a forecast, but we wanted to show you different scenarios. So there's a base case scenario, which is on the left, and the upside scenario on the right. The base case scenario has rent growth at 2.5% in 24, 3% in 25, 4% in 26, 3.5% in 27, and 3.5% thereafter. It's also growing expenses at 3.5%, and the exit cap is at 4.5%. In the optimistic case, we took those same rent assumptions for 24 and 25 from our team. We grew rents in 26 and 27 at 6%, and then again at 3.5% and 28 thereafter, and then 2.5% expense growth, and used a more aggressive cap rate, which is 4%. The reason for the increase in rent growth in 26 and 27 is that there's not going to be supply. There's supply delivering now. There's some supply north of us, in I would call it inferior location, that has recently delivered, but nothing is going to deliver between us and Bishop Arts District, and nothing's going to start right now. Interest rates are so high, it makes apartment development nearly impossible. Costs are still very high, so you're not going to see new supply. So there's going to be a lack of, as long as Dallas keeps growing, there'll be a lack of housing. And in 26 and 27, we're kind of coming through this. That existing supply, once it gets eaten up or taken up, will increase the rents. And so that's what we're expecting in that optimistic case. As you can see, so it's a little confusing, which I'll explain, but as you can see, basically in the base case scenario, or all cases, everyone's getting all their capital back is the projection. We don't project a scenario where people are not going to get made whole on their investment. The second thing is that there's the yellow or teal is light green is the original investment, non-participating investors. The light blue is just the new capital that's going in. This assumes 3 rounds of capital calls. So what we're doing now is we're raising for a 12-month cap extension, but we plan just in this projection to raise 12 months from now again for another cap purchase, and then 12 months again for another cap purchase. What we're doing also is that we're going to hold back as much cash as possible. The property itself should cash flow. So what we'd like to do is have as small of capital call as possible, or preferred equity issuance, which is the technical term. So we may be able to minimize some of that. I know that when you factor in the 10-year hold, you actually start to get the distributions, and that preferred equity starts to get paid back through cash flow. So anyway, that's the overall plan, which we can go more into the Q&A. The dark blue is the combined return. And so you'll notice that some things, I think it's kind of interesting at times that, the light green can be higher than the dark blue for non-participating, but it's a factor of dollars in and timing of dollars in, if that makes sense. So we do think that, in both scenarios, we want to hold the property at least through 2031 if we can, without having to do significant capital calls. And that the asset will continue to improve, especially from cash flow perspective, as the retail gets leased. You'll also notice that there's not a significant refi deficit in either scenario. So in the base case scenario, the refi deficit is $1.75 million. In the optimistic scenario, there's actually a refi surplus. So this is depending on timing for the retail leases, is the big goal and when they start paying. So, it's important to note, I think that assumptions can be tricky, but in the base case assumption, there's a 3% rent growth on average, and we have a 3.5% expense growth. So you're not getting much NOI lift. There is room, I think, for expenses to come down as property taxes come down. That's one of the things that I know we'll get into, is how we get the debt yield. And if you look at essentially where property taxes are today for Dallas County on last year's rate, we would actually have a decline in taxes this year. So I do think that instead of expenses growing up every year, we could have a decline. But as mentioned, rents should continue to grow as supply gets absorbed. The main growth is through the retail leasing, and we forecast nearly $800,000 of retail income in 2026. So in the preferred equity issuance letter, as I mentioned, there's likely going to be additional capital calls as the loan matures in 24, when we either extend it or we buy a new interest rate cap, or we sell the property. There obviously wouldn't be a capital call then, or we refinance it with a new loan. It's hard to project in this environment where rates are going to go. This is assuming rates stay high at this level. Our goal is essentially, though, to refinance the property when we can at a fixed rate level, fixed rate loan. From my perspective, real estate is a cyclical business. this downturn that we're in right now marks the end of a cycle, and the upturn, which we expect to occur in 2025, will begin a new cycle. And the reason why we want to hold through 2031 is that it's always better to sell further into a cycle, as we learned from the great financial crisis. You know, if you bought a property in 2008, you sold it in 2012, maybe you broke even. If you kept it through 2016, 2018, you did really well. And so that's what we want to try to accomplish with as little additional funds as possible. So in the capital raise, we expect 55 to preferred equity issuance. We expect 55 to 85% participation. One risk in not participating, I will say, is that the property does turn around, it can be refinanced next year. And in that scenario, the new capital likely won't be able to be taken out. So this capital would be diluting existing investors that don't participate in, existing people that don't participate in, not with the ownership, but just with the cost for the preferred equity. And obviously, I want everyone to be aware of that risk. Refinancing in 24 is optimal, but we have until the end of our extensions, which is July of 26. First of all, I want to reiterate that I'm sorry we're in this situation. My goal in this preferred equity issuance is to maximize participation in accordance with the company agreement and prolong this investment and maximize the potential of a mistimed acquisition or a misfinanced acquisition. If I had the liquidity to fund all these borrowed investments with floating rate loans, I would. I've funded lots of AP in the past to avoid capital calls without interest, and other groups typically charge for those services. I'm also committed to funding an additional $500,000 along with my existing pro rata portion, and I'll have over $2 million in the property, most likely. We're not positioned to really make a promote or make money on the asset. This doesn't even include my family's investment as well. So I'm not focused on the promote. I'm really not focused on that at all. I'm focused on our reputation and doing what's right and best for our investors. This unfortunate turn of events has made our interests more aligned than ever. And I have an obligation to investors to see this through this cycle for the benefit of everyone. We don't want to exit at this part of the cycle for a well-located quality asset like Vance at Bishop Union. Furthermore, we purchased the property for $77 million, and current replacement costs today are over $90 million. And I think that over time, that those costs have to at least come back to somewhat in unison as supply, the demand picks up and we need more supply. So I reiterate that I take responsibility. I'm a well-aligned large investor in the project, and I'm committed to putting more capital in the property and holding it through the cycle. So I know we'll have more time to really dig in the Q&A, and now I'm going to turn it over to Jarvin Shen, who's going to talk about the preferred equity issuance and the 12-month cap purchase.
Great. Thank you, Eric. I'd like to start the discussion with an overview of the property's current loan and issues surrounding that, and then turn attention to the structure of the preferred equity raise. So currently, the mortgage on this property is a 3-year term that expires in August 2024, with 2 one-year extensions to extend maturity until August 2026. The main goal for Barvin is to carry the existing loan until maturity in August 2024, and then reassess the rate environment and capital markets at that time, with a current bias of extending the loan at that time for at least one more extension, that is until at least August 2025, but presumably until August 2026. The biggest problem that we have to extend maturity is the need to meet the debt yield covenants. With the current loan documentation unrevised, the debt yield needs to be 6% in August 24 to be able to extend maturity by 1 year to August 2025. And then further, the debt yield needs to be 6.15% in August 2025 to be able to extend the loan maturity to August 2026. A debt yield is simply the net operating income divided by the notional amount of debt outstanding. As outlined in the capital call notice you received, Barvin did not renegotiate with our lender Barings on loan documentation Because Barvin believes that the property will be able to achieve its 6% debt yield hurdle that is needed for the first loan extension and the 6.15% debt yield hurdle for its second loan extension. This is fortunately unlike the other debt yield tests on the other assets that Barvin had to renegotiate down with lenders. This capital call is used to fund a 2% SOFR rate cap through August 2024. This again will leave Barvin to possibly buy subsequent annual rate caps in August 2024 and August 2025 to the extent Barvin elects to extend maturity on the existing loan at those times. Simply stated, Barvin's strategy for calling capital for a one-year rate cap is to provide as much financial flexibility to react to changing debt capital markets. For example, with the SOFR rate projected to decline over the next couple of years, Barvin did not think it was prudent to buy a rate cap beyond what is currently required by lender, i.e. the one-year rate cap. It also provides flexibility to the extent that Barvin will be able to pursue other fixed rate financing options beyond the first rate cap duration that expires in August 2024. So just backing up, a SOFR rate cap is a hedge whereby any SOFR rate overage above the rate cap, in this case, the 2%, is not paid by us as borrower when calculating total interest paid. So let's take a simple example. Let's say the SOFR rate is 5.25%, which is where it is approximately now. The interest rate is calculated at SOFR plus 300 basis points spread. 100 basis points equals 1%. So with a 2% SOFR rate cap in place, the interest rate is 2% plus the 3% spread equaling 5%. If SOFR increases further beyond 5.25% or stays anywhere above 2%, the interest rate we will be paying is still 5%, since SOFR is capped at 2% and there's a 3% spread. If SOFR falls below 2%, say to 1.5%, then the interest rate we will be paying is 4.5%, which is the SOFR rate of 1.5% plus the 3% spread. Now I'd like to turn attention to the preferred equity structure. Prior to this capital call, you have received an amendment to the original LLC agreement where a new class of preferred equity was voted on and authorized. This preferred equity is essentially a substitute form of capital with substantially the same terms and economics to the optional loan form of funding that is already referenced in the original LLC agreement. So instead of opting to call capital using the optional loan provision, Barvin instead is calling capital in the form of preferred equity. The preferred equity will accrue and not pay a current 10% annual rate, much like the stated 10% interest rate on the optional loan. In short, there are different tax consequences between a loan and preferred equity, and those differences arise because a 10% stated return on the preferred equity is accrued and is not a guaranteed payment, and therefore may be taxed as capital gains versus ordinary income. We are not here to give you personal tax advice, and we suggest you consult your own tax advisors on this matter to understand the possible tax advantages of preferred equity. Given that the preferred equity is not common equity or members' equity, any funding of the preferred equity is not dilutive to the ownership of the existing funded equity, meaning all existing members or shareholders' equity remains pro rata the same. However, the preferred equity will be senior in right of payment to all existing funded equity. In other words, when there is a monetization on this asset, the notional amount of the preferred equity plus the 10% accrued return per annum will get paid in full prior to any distributions to the existing equity. So even though the preferred equity is non-diluting pro rata ownership interest, it may be economically diluting equity returns in the sense that it is senior right of payment to the existing funded equity. With that, I'd like to turn it over to Randy L., who will talk about operations and property performance.
Thank you, Jarvin. Good morning, everyone. I'm going to give you a brief overview of property operations at Vance at Bishop Union. Vance at Bishop Union was initially managed by a third party for our first year of ownership beginning in mid-July 2021. We took full control of the property in mid-July 2022. So we've operated Vance in-house for a full year now. Since purchasing the property, we've maintained our average occupancies somewhere between 95 and 96%, and have grown our revenues by 14% and NOI by 16.5%. Today, our occupancy is at 94 versus our competitors' occupancy at 93%. However, we're leased at 98.3%. For the first 6 months, our controllable NOI for 2023 is just 0.5% under our budget, and our total NOI is off our budget by just 1.3%. Our controllable expenses quarter over quarter, however, were up about $50,000, but due mainly to higher turnover costs due to increased move-outs for the quarter and the fact that June was a 3-pay period month. Our average effective rents are $226 a square foot, which are basically in line with our June 23 budgeted goal. We are, however, ahead of our competitors whose average effective rents sit at $2.17 a square foot. And currently we're not offering any upfront concessions at this time. And on a good point, our retail activity has shown tremendous improvement in 2023. Salon Lofts is working on completing its build out and should be open in the next 60, possibly 90 days at the outset. As of today, Salon Lofts has almost completely pre-leased all of its spaces to individuals. We've signed a lease with Hot Works Yoga and are in the final stage of signing a lease with a Mexican restaurant, which will be just off the main corner of the property. This very popular local restaurant is expecting this to be their new flagship, and as such should help drive additional retail traffic. These 3 leases comprise approximately 45% of our total retail space at Vance. We're also in discussions with the dog daycare, boarding, and grooming salon, and we believe that all this activity will help drive other businesses to look at the remaining spaces we have at Vance. These retail businesses will build value for the property and add additional amenities for the residents. The property, as Eric was telling you, is positioned very well within our submarket, and we're one of the newest properties there that has been built over the last several years. If you haven't seen the property, it shows very well. It has a great amenities package, and it offers the residents walkability to the retail and nightlife in the Bishop Arts District, and also a very short commute, either driving or taking the light rail to downtown and other employment areas. I'm always guarded to say we're in a protected niche, but we're in about as good a niche you could be in the 2 markets that we sort of straddle. We straddle the Zhang Triangle market and the Oaklawn submarket. And being in that Bishop Arts District protects us a lot, and I think is one of the reasons we've been able to hold such high occupancy and are able to grow rents and are better prepared for some of the product that's coming online. So with that, I'll turn the call back over to Kate to answer any of your questions.
Thank you so much, Randy, and thank you, Jarvin, and thank you, Eric. I think investors will really appreciate the transparency and the humility and leadership you've shown in your overview. I'm going to kick off the questions. Just as a reminder, please, everyone, submit your questions in the Q&A tab at the bottom of this screen. To begin, we have, and thank you again for everyone who submitted their questions in advance of today's call. The first question is directed towards Jarvin. Jarvin, is the preferred equity offering that we've shared with investors voluntary, and is it dilutive if you do not participate?
You're on mute, Jarvin.
Great, sorry about that. Thanks, Kate. So this capital call is entirely voluntary. If you choose not to participate, again, you maintain your pro rata equity interest from the original funded amounts, from all the original investors. But the capital call is an entirely separate class of capital with a stated 10% per annum accruing dividend. So again, not dilutive from an equity pro rata ownership, but it is economically dilutive to your equity ownership. Again, in the sense that the preferred equity and 10% accrued annual yield will be repaid before any economics come to the existing funded equity.
Thank you, Jarvin. The next question we have is directed towards Eric. Eric, what is the path to the 6% debt yield extension test in August of 2024? What needs to happen for Barvin to get there?
Yeah, so when we did the forecast, we looked at a few things. Like we said in the return model, I think we only grew rents 2%, so it's not a big rent increase on the multi. We did increase insurance because insurance has gone up, and we also used for this year, which kind of factors into next year when they actually calculate the debt yield. Our number in Dallas County tax appraisal with last year's rate. We actually expect that number to go down because we're in litigation with them, but we started to use that high benchmark number as a kind of make sure we get there. And then it includes Salon Lofts paying us rent, Hot Works paying us rent, which are both signed. I think Salon Lofts opens in a month, and Hot Works has a certain period before they have to start paying. And then El Bolero, oh, sorry, I'm not supposed to say the name, but a Mexican restaurant who is popular in Dallas and has basically agreed to everything. We have a final lease document that we just need to sign with them, and hopefully that happens today or tomorrow. And it includes, I think, a portion of their rent, because they're gonna, the way that these are calculated are really on trailing 3 months. And so if you figure it's as of August of 24, they're really looking at probably May, June, July numbers. And so essentially they're going to just be opening probably right around this time. And so it's only a small portion, but with those assumptions, we get to a 6.
Thank you, Eric. The next question we have is directed towards Randy, which kind of is connected to that question. What are we doing in terms of cost saving measures at the property, Randy?
Well, if you've been on any of the other calls, I think I've stated one of the, our biggest expenses of the property are obviously debt service expenses and taxes and insurance. And beyond that are the normal controllable operating expenses. With these Class A communities, the residents expect a certain level of service, cleanliness, et cetera. So what we're doing is trying our best to reduce our spending without sacrificing quality so that we can maintain occupancy, obviously, and attract new residents. To date, I will tell you, through the first 6 months of this year, our controllable expenses are 10% below our budget for 2023. So we are always renegotiating contracts where we can, and as they come up for renewal, we are doing a lot more work in-house where we can so that we can avoid using outside vendors that are obviously more costly. And we're just trying to keep an eye on all of our spending and making sure that if we're spending money, it's going to improve the property, serve the current residents, and help grow our reputation and help bring in new prospects. So I think everybody probably understands that since the pandemic, not only have our taxes and insurance grown exponentially, but the above the line expenses have taken a hit. But what we're starting to see is those expenses are starting to normalize because people have gotten the increases that they want. And we've gone back to our vendors, and I don't want to say we turn our pockets out and say we can't afford it, but I turn my pockets out and say, hey, there's got to be a stop. And our vendors, because we're loyal to them and they're loyal to us, a lot of them understand that, and they've held pricing for us, and a lot of them have cut their pricing. And I think it's because I'm not the only one asking. I think other companies are doing the same. So we're doing all we can to keep those expenses down. And believe me, if we spend $1, there's a reason for it.
Yeah, I'm glad you didn't walk us through the 1,000 of line items you review
yeah.
every day at the property.
Sure.
So thank you, Randy. The next question we have is directed towards Eric. Eric, at one point there was an HEB rumored to be in development, or the owner of the lot across the street from this. Are there any updates in terms of HEB's development near the property?
So HEB does own the land next to us. There was actually an agreement with our property that we couldn't put a grocery store in if, by, I think it was a certain period, 23 or 24, to prevent them from having competition. So they do own the land. It's supposedly still in the pipeline. It's supposed to be a Central Market, which is their high-end brand. They do quite a few of them in Dallas. And in terms of when it's happening, we have no idea. I think we saw a few months ago a city council person saying that they were working on it with HEB to get it started, but who knows if that's real or not real. We'll believe it when we see the dirt start moving.
Thank you, Eric. The next question we have is for Jarvin. Jarvin, this is kind of a two-part question. In the first quarter update, we spoke about the lender negotiations at the property, and I know you addressed some of this in your remarks, but can you give maybe a concise update on how the lender negotiations process worked and why we decided to move forward without a deal with the lender? And said another way, also why Barvin is taking an approach with a 12-month interest rate cap versus reducing the debt or coming to a different pay down term with the lender.
Sure. So quite simply, Barvin elected not to renegotiate with the lender at this time because there wasn't anything imminent that Barvin needed as a concession from the lender. This property is in compliance with all of the loan covenants as Barvin calls capital for and purchases the 12-month cap rate as is currently contemplated by this capital call. And again, as mentioned earlier in my commentary, Barvin believes that the property will be able to achieve its debt yield hurdles to get through the second loan extension for an ultimate maturity by 2026, right? So again, there wasn't really anything to negotiate there. Barvin elected not to call capital to purchase an extended rate cap, meaning a rate cap beyond the 12 months, because according to today's SOFR forward curve, the SOFR rates are projected to decline in years 2 and 3. So purchasing rate caps later would presumably be less expensive.
Thank you for not going into a summary about the risk premium associated with duration costs and keeping it high level and simple, Jarvin. The next question that we have is directed towards Eric and so submitted in the live Q&A today. Is it possible for investors to come out of this investment? And if so, would we lose any of our initial investment?
So I think the question's asking just about liquidity and selling their interest. So we typically have a process for that, which is we market it to other investors. We basically send an email out saying an interest owns this percentage, their original investment was this, and connecting that investor, essentially kind of taking bids and then connecting with that investor with those interested parties. And so I would say, just knowing the environment, it's probably difficult to get out at par. A few factors go into that. One being that all investors in this project received depreciation when they invested, and you can't transfer that depreciation. So the investor buying your interest will not get that depreciation. The second issue is typically there's a discount for illiquid assets. The range can be 30% of current value. I think the IRS lets you do 35 or 40% of current value. So obviously it's not an ideal time to get out, but we're not going to know the value until we kind of send it out to other investors and see who's interested.
Thank you, Eric. The next question that we have is for Randy. Are there any nearby properties in lease up or anticipated to be in lease up soon that will compete with this property?
Well, there's about 4 properties, around 1,300, give or take, units that will begin delivery over the next 18 months. But none of them are actually in the Bishop Arts District. And the closest property, they go from a mile to a mile and a half. And they're all north of us, along the North Beckley, North Zhang corridor, if you will. And I can say that our resident base advance is much different than the resident base on those North Beckley, North Zhang corridor. And that's because Barvin owns and operates a property up there, Los Altos Trinity Green. And I can tell you that we don't trade much traffic with Los Altos advance. So, being in the Bishop Arts District is absolutely a distinct advantage that we have, and that those properties that are going to be coming into lease up don't have. So I think we're slightly protected in that way.
Thank you, Randy. I know you addressed some of that in your comments too. The next question that we have is for Eric. Eric, how or when will investors know the status of other investors who have or have not contributed the additional capital?
So we kind of, like I mentioned, we gave a range already in the call today of 55 to 85%. I think what's happened on other preferred equity issuances is that we send out your pro rata share. We ask investors to participate at their pro rata share. Obviously, if everyone does that, then there's no second round because that's it. Everyone participated. On other projects, there has been a second round. And so we'll go back to those participating investors and say, here's what your share is of the balance. Would you like to participate in this round as well? And so that's kind of how we'll close it. And whatever is left over, I'll take.
Thank you, Eric. Just so everyone knows, we do try and be very communicative about where we are at on the raise with other investors. We'll send out the next update likely a week from this Friday about where we are at the fundraise, and we'll begin our outreach for calls after this group call once we send a link in the transcript. So on Friday and next week, you'll start hearing from us asking for direct meetings if there's any questions that were unanswered following this call. The next question we have is for Eric as well. How will the decision be made to refinance, sell, or extend the current loan in 12 months?
So we're going to evaluate all of our options. We'll get BOVs from brokers. We're going to get obviously quotes on loans, and then we'll look at the extension with our current lender. I think that what we want to do is minimize the capital call to investors. That's probably first and foremost. And so if we can do that in a kind of small capital preferred equity issuance like we're doing today, around 8%, I think we would probably stick with that if that was our best option, opposed to taking a loss or something like that. So we have a lot of options here. It's a great asset. I would say it's a core asset. The retail income is going to grow significantly over the next few years. I think it's worth holding on to. And we always have the option, not that we're necessarily going to take it 12 months from now. We do have the option, if the retail is full, to sell just the retail. The property is set up from a legal perspective, so we could condo out the retail and just sell the retail. I don't know what the market is for that. I don't know what cap rate in today's environment that would sell for. I don't think it'd be very low. I think it'd probably be a high cap rate and a low value, but over time that income is really valuable to us because a buyer may not necessarily separate it from their multifamily income, maybe to a scale, but a lot of buyers of mixed use like this look at the retail as an amenity, and that amenity income, that income really can contribute to pretty significant in-place cap rates if we can get everything stabilized and full.
Thank you. Is there any additional comments you want to share about the lease up or the retail, or do you feel like that was pretty holistic? We've just received a couple of questions about the retail, but it does seem like it's been well covered on the call so far.
Yeah, I mean, I think, like I said, like Randy said it very clearly, Salon Lofts is they I don't know what you call that. They screamed their windows saying coming soon. You know, it's creating a lot of energy, I think, just in the area to see something. Think about it, this retail has been vacant for 4 years. So to see someone coming soon is fantastic, right? And then HotWorks is a great resource for, I mean, these are all great resources for residents, right? You want to get your hair done, great. You got a place downstairs, high-end place downstairs. You want to get a workout in, great place downstairs. The Mexican restaurant, which hopefully will be done this week, that's a fantastic resource. It's a very famous brand in Dallas. So I think as other groups start to see that there's activity here, they'll be very interested. And that's what we're thinking. And we're not even talking about raising the retail rents as the space fills up. I mean, I think that we probably could, but just getting the fact that we're getting triple net rents instead of gross rents at the same levels is a win already. So,
Thank you, Eric. The next question, we have a couple questions that are left in the time allotted. The next one is directed towards Jarvin. Jarvin, if Barvin extends the current loan rather than refinance or sell in 12 months, will the preferred equity issued in 12 months to purchase an interest rate cap at that time be senior in repayment to this equity?
Yes, so it is important to repeat that this capital call is not calling capital to fund subsequent rate caps beyond August 2024. So investors should expect further capital calls as sources of capital for those future cap calls should Barvin elect to extend maturity. Further preferred equity capital calls will actually be senior in right of payment to this current preferred equity capital call. You can just reference them, as per the amendment to the operating agreement, authorizing different classes of preferred equity. So if you're wondering why we put different classes in, it's really to tranche out. So, i.e. the later the preferred equity raise, the more senior it is to pre-existing classes of preferred equity.
I would just add that I think it's a fair estimate to make that the percentage would go down over time because we'll have additional income from the retail that can support and contribute to that extension cap purchase, right? And so assuming that, obviously this is a big assumption, that rates follow the yield curve, which we made that mistake previously. So we don't want to put too much faith in that, but assuming that they kind of go in that general direction, it in theory should be coming down just because we'll have the cash flow from the operations of the apartments and from the retail to contribute to that amount.
Thank you, Eric. I'm just going to ask investors to submit questions. We have 5 minutes left. So any questions that you're comfortable submitting or that you would like to be asked on this platform, please submit them directly and we'll be happy to ask and appreciate your time. So the next question we have is in August 2024 loan maturity and debt yield covenant risky given the presidential election cycle that will be just a few months from then? How do you expect to see better rates?
Well, I'll tell you, one of our board members said that rates are going to come down because they do in every presidential election. So if he's right, then we'll be in a better spot. It's hard to say. I think that, like we've kind of emphasized, we should have no problem with the extension. And that's our backstop. The other options, which would be refinancing the fixed rate debt, are better options if we can make them work, but that would require rates to come down a bit. So I think that our backstop is pretty secure regardless of any presidential candidate.
Maybe I'll just add, say, slightly differently. If you actually take a look at what the SOFR rate curve actually projects, again, right now we're about 5.3%. In August of 2024, it's projected to be about 4.8%. So it's a decrease of about half a percent, 50 basis points. So that's probably the market's best guess.
Thank you, Jarvin. And it seems like this is the end of our Q&A. If anyone has a question outstanding that they didn't feel like they got answered on this Q&A or didn't want to ask on this platform, please email us directly. I want to thank Eric, Jarvin, and Randy for joining us today, and for all of our investors who are joining us on this live call, as well as this reporting. We know that it's not easy for you to listen to this call, and we know that it's not easy for us to be on this call, but we will continue to be transparent with you and available and open if you have any questions. We thank you for your time, and we look forward to speaking with you soon. We hope everyone has a wonderful day.
Thank you, guys.
Thank you, everyone.
Bye.